Tesla planning to lay off more than 10% of its global workforce. Also, two key executives, one named Drew Baglino and Rohan Patel, have announced they are leaving the company. These are senior level executives. Now, Musk appeared to address the shakeup in a post on X, saying, quote, about every 5 years, we need to reorganize and streamline the company for the next phase of growth. Tesla shares fell just over 5% today, closing at their lowest level in nearly a year. Has Tesla lost some of its magic, or is the shakeup a sign of growth to come? With us tonight is Tesla investor and Deepwater Asset managing partner Gene Munster. Gene, you think this actually foretells growth, but we're talking about people leaving, being laid off. Try to square those two things.
Well, Brian, I think what's going on in the next, call it 2 to 4 quarters, is going to be a decline in the business. Maybe start with there. I think that this is a reaction in part to the EV demand that has absolutely hit the wall. Just look at Google Trends, type in your favorite EV, and look at how the amount of interest has declined. I think ultimately deliveries in 2024 for Tesla are going to be down 3%. The street's right now at plus 5%. That's come down since over the last few weeks. It's still too high. So I do think we are in a period here before what I believe will be in this period. This is the classic Gardner hype cycle. We're right now in the trough of disillusionment. And I think that we are going to return to growth because ultimately I believe electrification is just a more sensible way to move around and along with autonomy. And so I still believe that Tesla's a growth story, but not for the next year.
Okay. But how do you feel about $99 full self-driving?
I think that eventually, if you're somebody who's born today, it's probably never going to drive a car. I think that if you look at the value on this, there's a piece where you can look at what the adoption is. If they get 20% adoption, I think that that can double their operating income by 2028. And so I think that it's not for everybody, but if 20% ultimately decide to do that. And separately, eventually all car companies, just for safety reasons, are going to have to get some form of autonomy. And it's unlikely, given what the investment cycle has been with these car companies, that they're going to be able to do it on their own. I suspect over time, Tesla will license some of that. Elon said he's open to that. That's a whole other revenue piece that is not reflected.
Next guest says the equity market has entered a correction and that if the S&P 500 fails to hold near its 50-day moving average of 5111, which it breached yesterday, then the risk is now moved toward the 100-day moving average, which is near 4,900. For more, let's bring in Ann Bartels, Chief Investment Strategist at Sanctuary Wealth. Ann, great to have you with us. If we do drop to that level, then what leads us there to the downside?
Well, obviously, as Dom just highlighted, interest rates have been backing up and the market has not liked that. In addition, the geopolitics, I think, are making investors very nervous. But Melissa, remember, markets have 5% corrections 3 or 4 times a year, 10% correction once a year. We were expecting a correction after the first quarter was up 10%. And the markets rallied 30% off the October low. So as the saying goes, April showers bring May flowers. Well, we think the equity markets will blossom. So we're still buyers of the market here. And in terms of risk, we're watching crude oil. We think that would be the catalyst for a very deeper correction if crude got above 100 and stayed above 100. But right now, we don't see that happening. We see actually crude oil falling.
Blooms like the one in your hair, Ann.
Yes,
Very cheery on a Tuesday. How can you miss that beautiful daisy? But I want to talk to you about some of these sort of things in the markets that we may be watching, crude and treasuries, because, on the back of what's going on in the Middle East, they're not necessarily reacting as strongly as one might think. And there are a lot of sort of wonky things going on. I mean, crude, some think that, OPEC Plus could sort of cap the lid on crude going much higher. And then for the treasury market, there wasn't a huge bid for safety. And maybe that's because of concerns about issuance and the stronger retail sales report. So can you talk to us about how you sort of factor in these what otherwise would be indicators to you about where the markets would be going, but how other outside influences are actually clouding how these indicators are moving at this point?
Well, as you pointed out, retail sales came in much stronger than expected, and that really moved interest rates. But that's actually a real positive. That means the economy is doing well. The consumer is still spending, and they're the majority part of the spending in our economy. We still have a tremendous amount of cash on the sidelines, and net worth is at a record all-time high. And although, there are stresses in the Middle East, as long as the supplies of crude oil are not contained in a very long-term detrimental way, we think the markets can recover. And maybe an example of history that we can use is I remember the markets of 1990 when Saddam Hussein invaded Kuwait. Markets went down sharply. They went down 20%. But within 2 months, we got a full recovery. So, I don't think that this is an opportunity to really sell. I think it's appropriate to review your asset allocation. And if you have too much cash on the sidelines, we're telling clients, get your buy list out. We think that this is going to be a good buying opportunity.
This has, again, as some would suggest, the makings of a go big or go home market right now, just because of where rates have backed up to. If volatility is going to pick up, why wouldn't you stay with the largest stocks, most dependable in quotes, within the market? Maybe that steers you to the mega caps, which you've been adding to, by the way, like Apple, which you added to again.
I did, and I'm now overweight in Apple.
Okay.
Just because it's underperformed so massively, and I do think it's underowned relative to its historical average, where I think the rest of FANG actually is pretty well owned. And I actually took a little bit of Amazon profits and put it into the Apple because I do think the risk reward is better. The numbers have been coming down. We know how bad China is. They are eventually going to fix it. I still think they're going to be able to grow double digits in earnings with record margins in the face of really challenging environment. We have services that we have to look forward to in terms of double-digit growth. We have AI to look forward to. Look what happened last week when they talked about Mac and having new products with AI. It was up 4% in a day. I mean, one of the biggest days that it's seen in over a year. So to me, I'm looking for places. It's not necessarily all of the FANG and all of, go big or go home. It's trying to pick some spots where I think there's really good value and good risk reward. Apple, I think, is one of them.
Jimmy, long Mag 7 continues to be the most crowded trade. And that, again, according to the same fund manager survey that I referenced just a moment ago, the one that was the most bullish in the market since January of 2022.
I think we need to retire the name for the obvious reason that Tesla is just
you could take out, you could call it the Fab 5, whatever.
I think this,
you can do whatever you want.
Extends,
you know the point.
I think this extends the comment that you started with the show. Do we need to change the playbook? Should we change from the broadening of the rally back to the narrowing of the rally? I've given my answer. I think the answer is no. Having said that,
what's up today, by the way? I don't mean to cut you up, but what's up today? Nvidia's up, Microsoft's up, Meta's up, Amazon's up, Alphabet's basically flat, but
Apple?
At a point of, well, Apple's had its own issues. At a point of alleged turmoil within the market, the safety trade has been back big. Mega caps. No. I mean, today, if you want to pick today, no, I'll explain to you. If you want to pick today, that's fine. But take a look at beloved NVIDIA, which I like a lot, and I'd like to add to it. This has been the most defensive trade in the market for the last year and a half.
Well, what's it off from its recent high?
It doesn't matter if it's off from its high.
How can you say it doesn't matter?
It's been the most defensive trade in the market. That's why the stocks have worked more than anything else.
Hang on, Josh. I'm in it with Scotty. I got to finish this, okay? The market, God, you killed me today. The market's down 4% from its peak if you measure it from the S&P 500. What's NVIDIA down from its peak? 10%. Stop it. It hasn't been defensive. Not in this pullback.
Not within this most recent market upset.
No, that's what we're talking about.
There's a reason why these stocks dominated the conversation for as long as they did. And investors have been able to play both offense on AI and defense for safety and good balance sheets through a lot of market turmoil, more so than any area of the market.
But not recently.
Prove to me otherwise.
Not recently.
Not within the last few weeks or a month of the backup in rates when we started talking about higher for longer. Now I'm the
short-term guy.
But it used to be that Mag 7, they were the only game in town in terms of earnings. Everybody else didn't have really good earnings.
Well, the most dependable ones.
And so now, and I'm talking, and now, fast forward, look back at fourth quarter. If you look at energy, financials, industrials, they kept up with technology. That's my point. Like, if earnings were terrible in these sectors, or you didn't have a lot of visibility in these other sectors, that's one thing. But you actually do have better visibility in these sectors, and you have pricing power, and you have free cash flow generation, and you have debt pay down. These are stories that are, this has happened in tech, hasn't happened in these other sectors, but now it's happening. So that's why I'm saying, like, it's broadening out, and that's very exciting, actually.
But the earnings, I think the only point I'm making, the earnings durability has been way more reliable in mega cap tech than it has been to any of these other sectors over a longer period of time.
100%. That's why they call them cyclicals, because they're not. But at least if you get the cycle right, you can make a heck of a lot of money.
Josh, yeah, quick, and then we're going to take a break.
Sorry to be annoying. You are right. James is off. The Magnificent Seven, there's an ETF, very simple, MAGS. So if we want to speak about this group colloquially, just equal weight them in the ETF. They're up 15% year to date, which is better than the S&P, now 6. I'm using the SPY. And even in this recent pullback, they've held up better. They're like 1% off the high. The S&P is more. So I think, look, Tesla's an eyesore. Apple does have its own issues, but Scott is right. People are using these stocks, whether they should or shouldn't, we'll find out. People are using these stocks on days where there's volatility. They're clinging to them like a candle in the wind. That's undeniable in the price action. I'm not saying they should. I'm just saying they are.
And shares of Trump Media looking, well, down as well, plummeting yesterday as the company filed for additional stock issuance on the same day that former President Donald Trump's hush money trial began. The stock now down over 40% since it started publicly trading last month. We saw that filing come through literally while Squawk was on. We were trying to make sense of it. We're going to continue right now because Liz Hoffman is here, Semaphore business and finance editor and a CNBC contributor. She's got a big conference coming up in Washington, D.C. later this week, so congratulations ahead of that.
Thank you.
But let's talk about when you saw that filing, what you think that filing is even trying to say.
I don't know. I mean, I've read it a couple times now. I think ultimately it's actually not. They're not issuing new stock. They're registering some warrants that were sort of already baked into the pie. But again, like, this is a company that just, like, incredibly volatile, not that good at explaining anything it's doing, and heavily owned by retail investors who don't really know what's going on, which is how you end up with a move like that.
So, but I think the big question is, when do we think that this board, if the board is going to decide to allow the former president or others to sell their shares before the 6-month window, how does that work? What kind of disclosure would be necessary? Does the stock move up or down on that news? I mean, I think these are the things that I think people who are invested in this are trying to figure out. And then the question is what it means to be invested in this company.
Right. So for which way it moves, like, you can make a case for either way, right? Like, it floods the market with new shares, which should generally depress the price. But actually, there isn't. This is a hard stock somehow to get your hands on because there just isn't a lot of it. So you could see it, you know, creating a buying swell that kind of brings the whole thing up. I don't know. I mean, God, the shareholder lawsuits that would immediately follow waiving a lockup. You can do it, but I think it'd be pretty messy. But then I think to the point you're trying to make, it's like, why does anyone own this stock? This is a company with a single product that not that many people use. It has been losing money hand over fist. I'm not surprised. Eventually, I think you'll see them issue new equity because they're going to have to. I mean,
right.
So it was $60 million last year, I think.
Doesn't this allow them to get around the issue of the waiver? I mean, if it effectively brings forward some sales, and so it's to your point about, you know, like an uprising if a waiver were granted, it being so unfair, et cetera, this actually allows them to sort of get around that.
I think what it does is it would allow him to be, President Trump, to be more liquid in that it's converting some warrants into stock that he could perhaps borrow against. Mm-hmm. That's one piece we haven't really talked about and seen. There hasn't been a lot of disclosure, but there's a big slug of stock worth still probably $1 billion, $2 billion that he could borrow.
Look, there are people that you can find on Reddit and elsewhere who actually talk about this, not as a meme stock or as an investment, but actually as a financing vehicle. Literally a campaign financing vehicle.
You know the beauty of that, though.
A transfer of wealth from the investor community, could be effectively a donor who's saying, I'm effectively donating my funds to the former president by investing in this stock such that he can then sell his shares later to be used for the campaign.
And the beauty of that is that if you lose money, you take the loss. So you can donate money.
Right.
The stock goes up. You're like, oh, yeah, I'm supporting President Trump. That's exactly what I want to do. Stock goes down. You lose money.
Right.
And you take the loss.
But again,
gains
it's a little hard to tell. Like, again, you can donate to President Trump's campaign if you want to, but you could take the loss. But then are we assuming these are really sophisticated investors who are doing like tax loss harvesting?
Probably
don't really
not.
know.
But I'm
It's
just
hard to
saying that is
well, I think
totally a side effect.
what we need to watch for, by the way, is if in fact the stock actually moves higher in a meaningful way. Could it be that there are a bunch of people, very wealthy people, possibly people from outside the country or others, who actually literally are pushing the stock up? Meaning, it's not an investment. It really is a way to actually transfer wealth. Rather than just being a retail investor, which I always think when we use that phrase, it's sort of dismissive, but it shouldn't be.
I mean, for the moment, this thing is still trading to me like a meme stock, and
right.
It's going to be 6 months out from an election. I would expect it to be a bit of a heartbeat for the campaign. But this is more broadly, I haven't totally understood the business case for these kind of ideological echo chambers. You've seen Parler, Gab, Rumble, like they were all supposed to be the next big thing, and I don't think they are. And even more broadly, Public Square, kind of the America First marketplace. It was worth $20 a share. Now it's down under $5. Right. Like, I think if you're going to try to own the libs, these things are kind of built on conflict.
JP Morgan Asset Management Chief Global Strategist David Kelly. Oil prices weaker again, but I do wonder if they're out of the woods, especially if the Treasury Secretary is talking about more restrictions to Iranian oil and how they've been able to sell it to places like China and bring in a lot of cash.
Well, there is always a potential for a supply shock. And I think, obviously the heightened tensions between the United States and Iran and Israel increase the risk of either our sanctions or perhaps activity by Iran in the Strait of Hormuz having an impact on oil prices. But, in some ways, what you're reporting about China is equally important. Chinese consumers are they lack confidence, and that is slowing the Chinese economy down more than I think is portrayed in those GDP numbers. And that has an impact on total global consumption. So I'm not seeing that big growth in global commodity consumption, which would, push oil prices up to a permanently high level. So we've seen oil prices move up, and, they are at relatively high levels right now. They could get pushed higher by some shock, but longer term, over a year, 2 years, 3 years, unless we see more global economic growth, I don't think we'll see a permanently higher plateau in oil prices.
So what do you see as the stock market's next catalyst? It feels like we're adjusting here to a new rate path, or at least rate expectations from the Fed. We're in earnings season. Are the earnings going to justify these levels, and what comes next?
I think the earnings season will be okay. I think what the U.S. economy is proving, and you can see this in the jobs report for March, which seems like a long time ago, but it seems like the economy can do very good economic growth with still a lot of wage restraint because of immigrants coming in, and because workers in the United States are generally pretty passive in terms of demanding wage increases. Now, what that should allow happen is we should see that inflation decline begin to resume. It's sort of stalled out over the last 6 months or so, but I think we will see it begin to decline some more. And if inflation resumes a downward path, it may not be fast enough to allow for a June rate cut, but I think the rate cuts will come back on the table if that inflation rate begins to come down some more. So I think that's the most important thing to look at, is can we get a further slide in inflation here? Earnings, I think, will be good, but I don't think the market's really teeing off that. I think they're really interested in what's the rate environment going to be for financial markets in general.
Why are you confident that inflation will continue its downtrend from here, with the rise in commodities, with the seeming reacceleration in U.S. growth, including manufacturing, going back above PMIs, back above 50, expansion?
Well, growth's okay. I know that the Atlanta Fed is at about 2.8% for the first quarter, but we're lower than that. The housing starts numbers this morning were a little on the weak side. I'm not so worried about the starts as the permits, which were a little bit on the weak side. Retail sales look okay. But we still see the economy slowing down to about a 2% growth rate. And what's interesting here is the growth in immigration seems to be having an impact on labor supply, which is allowing us to do that with lower inflation. So first of all, I don't think you have that overheating. Second of all, if you actually look at the way inflation is calculated, there's so much of it that's in owner's equivalent rent and in auto insurance. Those two categories represent over 2/3 of the inflation that we actually saw in the month of March on a year-over-year basis. That's going to fade going forward, almost certainly, when you look at those numbers. So it's very hard for the overall inflation rate to go up if those two big categories are coming down.
NBC News reporting that Israel's response to Iran's attack over the weekend could be imminent. I'm going to get straight over to NBC's Richard Engel, who joins us from Jerusalem this morning. Richard.
So the Israeli War Cabinet, and good morning, is meeting again today for the third straight day in a row. And sources are telling NBC News that they are very much looking at a response, a military response against Iran for this weekend's attack that Iran carried out, a failed attack with drones and ballistic missiles and cruise missiles. But we're not exactly clear what kind of attack that is going to be, with four different U.S. officials telling NBC News that Israel is contemplating ways to send a message to Iran that they want to do the attack sooner rather than later, so that it is closely timed to the Iranian attack. They don't want to wait weeks or even many days, but they are trying to calibrate it in a way that doesn't provoke a wider war. And that is a lot easier said than done, because what Israel does and believes it is not provoking a war is not necessarily how Iran will perceive any Israeli reaction and action. And Iran has already said that if it is attacked by Israel, it will respond immediately. And according to those U.S. officials, some of the options that Israel is considering include attacks on Iranian proxies outside of Iran's borders. But those officials stress that a final decision from Israel hasn't been made and could change. So they are bracing in the United States and all across the Middle East for some sort of Israeli response. We just don't know where or the extent. And I think that is something that they're going to be calibrating or trying to calibrate today at that third War Cabinet meeting.